Hello, guys, and welcome to another brand new episode of the ITU Forex class. In this week's edition, we're going to be talking about how to trade with trend lines. So, if you've been trading for any length of time, I'm pretty sure if you've delved into technical analysis, you must have come across trend lines at some point in time. And basically, what trend lines are, they're just dynamic support and resistance levels, which are plotted on the charts using a number of points of price action. Okay, so to help you understand this better, let me quickly show an example to you. Okay, so the way we usually trade the markets based on support and resistance is we usually have support and resistance zones. We plot support and resistance zones on the chart. So, for example, if you take a close look at the charts here, where I'm pointing with my mouse, you'd notice that price had come into this region after it broke above it a couple of years ago. This is the weekly chart, so it's a couple of years ago. So when price broke above this area, which it found difficult to do in the past, this area turned from acting as a resistance zone to now acting as a support zone, as a floor. So consequently, whenever price comes to this level to trying to break below it, it fails to do that and it gets rejected, which in turn leads to the formation of this long wick tail candlesticks. Okay, and so price gets rejected, and then when it comes back to test it again, trying to break below it again, it gets rejected, which leads to the formation of this long tail candlesticks. Again, it tries to go above, tries to come back down and break below this level, but it fails to do that again, and then it bounces off of this level. Okay, now this is an example, this is a typical example of a horizontal support area, a support zone. Okay, the reason why I'm calling it an area or a zone is because it's not as if price is just respecting a certain particular number. Okay, let's say, for example, at the moment, when I right click on this horizontal line and I go to its properties, you can see that the price area on this, let's just round it up to, it's the 178.00 price level. Okay, but what I want you to pay attention to is the fact that whenever price comes in contact with this area, it actually breaks. Whenever it came in the past, that's when it tested it initially, it broke below this area. It just couldn't hold below this area to close below it, and then it got rejected. But then the next time when price came, it barely even touched this 178 area, and then it got rejected again. But then the next time when it came, it didn't even touch the area at all, and then it got rejected. So when we take a close look at this, you'd notice that the support and resistance areas that we have on our chart, they are not like, cast in stone price levels, like the 178.00 price level, that whenever price just comes to that level, it just gets rejected automatically. Sometimes it might be a couple of pips below it, or it might be a couple of pips above it. Okay, it all depends on how price is reacting to the area and all of that. Okay, now this is an example of a horizontal support area. Let's do another thing. When we take a close look at the charts, you see that this is a defined horizontal support area. Okay, but then when I place this line somewhere around here, you'd notice that this area has been acting kind of like a resistance area because we've had multiple touches. So what I want you to pay attention to is the fact that in the past, price actually found it difficult to break above this area. So it came from all the way down here, and then when it went here, it couldn't break above it, and then it got rejected slightly. But then eventually, when it gathered enough momentum and it came, it broke above this level. But this breakout wasn't kind of a breakout that was sustained for further upside movement. It was more like a fake out, because after price broke this level, it got rejected not too far from the level, and then price went back into the horizontal resistance, support and resistance zone. Okay, this is kind of like a horizontal support and resistance zone in the sense that this is bound. You're actually having the levels in between horizontal support and resistance areas. Okay, now the difference between trend lines and horizontal support and resistance zones that we're all too familiar with in technical analysis is that with trend lines, they are slanting at a degree. They are not like your regular horizontal support and resistance areas, which are kind of like flat. With trend lines, most times they are slanting towards an angle. Okay, so for example, if you want to draw a pretty good trend line, most of the times what you would want to do is to have it get a couple of touch points. The more touch points, the better, because touch points, what I mean by touch points is when you look at this line, this particular trend line that we drew, you can see that price came in contact with the trend line somewhere around here. And then when it came back, it bounced off of this level. And then when it came back again, it bounced off of this level. So we've had multiple touch points here. This was the first, this is the second, and this is the third touch point. Okay, so price has been respecting this area. Now this was way back in 2022, 2023. Okay, the later part of 2022 and the early months of 2023. But you can see that when we draw our trend line here, okay, when we draw our trend line here and make it touch all of these three touch points, you can see that all the way up to here, 2005, May 2005, you can see that price came to this level, but then it still respected this dynamic, this diagonal trend line that we have on the charts, and this area still acted as support. Okay, so can you? I'm hoping you are with me. Okay, when we're talking about horizontal support and resistance areas, usually they are drawn with horizontal lines, but then trend lines slant or slope towards an angle. And to draw good trend lines, you want multiple touch points so that it will not just be a random area that you draw on your chart, but an area where price has convincingly rejected or reacted to in the past. Okay, so this is our support trend line that we just drew for example purposes. Okay, now let's draw another one, and in this case, this is going to be our resistance trend line area. Okay, so remember I told you about touch points. The more touch points, the better. Well, take a close look at this. You can see that price tested this area of the trend line somewhere around here. Okay, and then it came back again, tested it here, and then eventually when we had this fake out, you can see that price could not maintain this upwards movement because it was kind of like a fake out, and then it came back to trade within the channel of this trend line. Okay, so this is a typical channel that you draw when you draw a resistance trend line and a support trend line. Okay, now you don't trade these trend lines alone in isolation. Like I always tell you in trading, especially if you're using discretionary trading techniques like this one, because I'm pretty sure you must have the question, even if you've not voiced it, you must have had the question in your mind that, okay, why am I using this and this and this and whatever this might be to draw this trend line, and I'm not using this? Okay, I could use this. Okay, some other traders might even use this, and you can see that even if I use this would have been our first touch point, second touch point, third touch point. But then when price broke above this level, again, it respected this trend line. Okay, so I can also use this. The thing I want you to understand is that when you're using tools like these trend lines, okay, these are known as discretionary trading tools. Discretionary trading tools in the sense that you need to use a bit of your discretion and your experience with trading the markets and the time you spent on screen analyzing price charts and all of that will come into play. Because when we are asked, for example, if I give you a clean chart without any drawings on it and I tell you to draw trend lines for that chart, another person comes and I give him the same chart as the one I gave you and I tell him to also draw trend lines, you two would probably end up with two different trend lines on the chart. Because when you're drawing this type of lines, you're using your discretion. But when we talk about mechanical trading techniques, these are universal in the sense that, for example, like a moving average crossover. When we're using something like a moving average crossover, when price crosses below or above the moving average, it's universal, okay? It's seen everywhere, and it's as simple as we take the trade, we do this, and when there's a crossover here, there's a crossover, all of us would see it, and we'll agree that, yes, there's a crossover, okay? But if there isn't, then there's no crossover, and we cannot place any trades or whatever. But when you're using subjective trading tools like this, okay, it's going to be a bit difficult for you because it requires your experience with the market, your screen time, all of those experiences you've gathered, your intuition and all of that, for you to be able to properly navigate the markets. Okay, so again, like I keep telling you guys, regardless whether you're using mechanical trading strategies or trading edges or discretionary trading strategies or discretionary trading edges, you need to know that you're not going to win 100% of the trades you take. So it's not so much the trading strategy, or it's not so much the method or methodology you use to identify when to buy or when to sell, or all of those things that's going to impact how profitable you are going to become as a trader. Much more than that is your mindset and your risk management. Because, for example, you can trade with whatever trading strategy you so desire or you choose, and you could maybe win only 40% out of the 100% of trades that you take. But if you're using proper risk management, then eventually you still end up being profitable. When I say proper risk management, I mean you are keeping your risk per trade consistent. It's not as if when you see one trade setup, you're going to risk 1%, and if that trade loses, then you're going to now risk 2% in order to try to recover the loss that you took from that other previous. No, there's no funny things like that. When you're taking a trade, if your risk is 1% of your starting account balance per trade, then you're not going to change that. On every single trade you take, you're going to be risking 1%. And then you also have the risk to reward ratio component of your trading strategy, of your trading risk management. Okay. So, for example, if you're risking 1% of your trading account's capital per trade, then how much are you aiming to make in profits on each trade you take? Because these two things, in conjunction with your method, your trading method, which tells you when to buy or when to sell, or all of those things, are the things that would put you leaps and bounds beyond traders who are struggling to make a living through trading. Because, for example, if every single time you take a trade, your risk is consistent and you're risking only 1% of your account's capital per trade, and then when you actually take a trade, you're risking 1% and aiming to make nothing less than 3% on the trades you take, then if you were to take 100 trades, okay, and then you lost 60 trades, remember, your risk per trade is minus 1% on each trade you take, okay? So you're going to end up with a gross loss of minus 60%. But for the 40 trades that you took, which all ended up hitting your profit target, each one of them gave you a profit of 3%. And so your gross profit is going to be 120%. Now, when you subtract your gross loss from your gross profit, which is minus 60% your gross loss, you're going to still end up with a profit of plus 60%. And this is even though you only have a win rate, which is only 40%. So the reason why I'm bringing this up is because whenever we do these strategy classes, most of the times people tend to misconstrue what is being, the points that we're trying to make. And then they think, we're just going to take a trade setup, and then when we take a trade setup using trend lines or whatever, we're going to have like a 90% win rate, and that's the reason why we're going to be profitable. Actually, that's not how it works. You could still be profitable even with a very, very low win rate. But you just need to make sure that if you are trading with a strategy that you know beforehand, that you've backtested, and you've proven that trading strategy has a very low win rate, then you need to couple that trading strategy's low win rate with consistent risk per trade and a good risk to reward ratio, so that whenever you're risking 1% of your trading account's capital per trade, you're aiming to make 2 or 3 times more than that, because that's the only way you're going to be able to survive at the end of the day, after the end of taking a lot of trades. And one of the problems that I notice with a lot of beginner traders is that you might explain it to them like this, give them a trading strategy that they will go and backtest, and they understand that here and now, what I need to do now is to keep my risk consistent and to aim for a good risk to reward ratio, so that even if I lose more trades than I win, I'll still end up being profitable. But do you know where the problem is? The problem starts when they go out to the live market and they try to place a trade. And so when they place their first trade, for example, it turns out to be a losing trade. And then they place the trade after that, and then it turns out to be a losing trade again. And then they place the next one after that, and it turns out to be a losing trade. By now, they have already started doubting the trading strategy, and they are hell-bent on changing that trading strategy or tweaking it. And then before you know it, they don't even have a strategy that they are following. And so they will start, taking random trades with random trading strategies, or based on emotions, or all of that. And this is the main reason. This is the main reason why trading is very, very difficult. Because a lot of them, instead of just sticking to the plan and just keeping your head focused and using that trading strategy, whether it's through good times when you're, having winning trades in a row, or whether it's through bad times when you're having losing trades in a row, they are having good winning trades in a row, they might start increasing their risk because they feel they're invincible. They've cracked the markets, they've cracked the codes, and they just want to become overnight millionaires. Or if they are encountering losing trades, a losing streak, for example, they might just start getting fearful, start skipping trades or revenge trading, or all of those negative emotions which are associated with losing trading. And then they would want to, they'll just mess up their trading plan, mess up everything. So in theory, trading is not difficult. You just need to find a methodology which is going to dictate when you buy or when you sell and how much you risk and how much you, all of those things. And then make sure that if that particular trading methodology has a low win rate, compensate for that low win rate with a high reward to risk ratio. So if you have a trading strategy that has a 40% or 30% win rate, make sure that when you take a trade, you are always aiming to make maybe 3 or 4 times of what you are risking on every single trade you take, assuming you keep your risk consistent. But then, if you know that your trading strategy has a slightly high win rate, like maybe 50 or 60%, or maybe even 70%, then you can very well go, make it with a very, modest win rate. Risk to reward ratio, like 1:1.5 or 1:2 or whatever the case might be. Okay? Now, going back to our trend line example, there are various ways that traders use to trade with trend lines, okay? So one of those ways is for traders to draw them on their charts using touch points. Remember, I told you what touch points are. So, for example, somebody might decide to draw his trend line using something like this, okay? The bodies of the candles or whatever the case might be, and tell you that, okay, the reason why he's drawing this trend line like this is because when he does it like this, it has more touch points. So when he draws it like this is a touch point because price is touching the trend line here, it's touching it here, touching it here, touching it here, touching it here, and all of those other levels, okay? So how does one trade it like this? Some traders would want to trade it whenever it comes here and they see a rejection, that price is looking like it's going to reject the trend line and continue moving to the downside, then they're going to take a short trading opportunity because it looks like the resistance of that trend line is acting up and it's going to hold. And so some traders might just, okay, price is touching this trend line, which had like 2 or 3 touch points in the past. And then now it's forming a bearish candlestick here. And so I'm going to take a short trade setup, place my stop loss above this area, because if price for whatever reason breaks above this area, then price is no longer going to come back to the channel of the trend line. And so it's going to take a trade looking to short the particular currency pair. And then the other way is for you to draw the support trend line. And so we have 1 touch point, 2 touch point, 3 touch points here. And you can see that when price tested it here, you can see that price bounced off of this level. And this would have been a trade setup again. You would have taken a trade here, a stop loss here, and then aim for your 1:2 or 1:3 or whatever the case might be. But then, whether you're using, remember, I keep emphasizing this because I know how easy it is to forget this, okay? Whether you're using trend lines to trade, whether you're using discretionary or mechanical trading strategy, whatever you're using, you are never ever going to win 100% of the trades you take, except if you have a crystal ball that tells you what's going to happen in the future. And if you don't have that, then risk management becomes imperative, because if you don't have 100% certainty in what the market is going to do, then you need to compensate for that by covering your losses. If you don't cover your losses, then you're eventually exposing yourself and risking blowing your trading account completely. Okay, you don't need to know what's going to happen next in the market to be able to become a profitable trader. You just need to trade with the probabilities in your favor, using all of the methods that we talked about, like a method which has a repeatable pattern in the market and proper risk management. Okay, and using the right mindset. So if you encounter like 2 or 3 losing trades in a row, do not dump your trading strategy and start looking for other trading strategies on YouTube or whatever, or wherever you want to search for that trading strategy. Stick to one trading strategy. Ideally, you want to test that trading strategy on historical data to prove that it has performed well in the past. And this is another thing that a lot of traders don't tell you. Just because the trading strategy performed well in the past does not mean that it is guaranteed to perform well in the future. And this is one of the reasons why you'd see a lot of the brokerage houses or the sites or the tools or whatever you use for trading, they always tend to have a disclaimer which is telling you that past performance does not guarantee future results. This is because trading is inherently risky. No matter how we might want to, play it down and all of this, we are playing a probabilities game. So there's no 100% certainty that because a particular trading method or a trading strategy or an expert advice or anything performed well in the past, that it is guaranteed to perform well in the future. Absolutely not. It's just we are playing the edges here. We're just having a educated guess that since it performed well in the past, we are hoping, and not just hoping because we have data to back our hope or research or whatever the case might be, we're hoping, making an educated guess that it's likely going to perform good also in the future because there are a couple of edges that came together to make this work in your favor. Okay? So this is why you need to, understanding this is the thing that is going to make it very clear for you that you cannot afford to trade the markets with money you cannot afford to lose because there's no guarantees in the market. If you decide that you want to get involved with trading, and all you have is your life savings, which you're going to be using to pay your rent or paying the kids' school fees or anything like that, that is not money you should be trading with, because the money you're expected to trade with is known as risk capital. Risk capital is the type of money or the type of capital that if you were to lose it today, yes, it might bother you a little bit, but it's not going to change your lifestyle. It's not going to, just completely change your lifestyle and you have to start living under the bridge or something, because trading is inherently risky. No matter how the numbers are going to be flaunted in front of you that it's likely to work or whatever, there's no guarantees in the market. Okay, so you need to understand this. Okay, so again, we talked about trading these trend lines when there's a bounce, but then there's also another method of trend line trading, which is when a trend line breaks to the downside or to the upside, depending on the type of trend line you're using. So to show you an example of this, I think I would let's change the time frame here, okay? Because since this is the weekly chart, I'm not sure I'm going to get enough examples to show on this particular time frame. So let's just quickly switch to the lower time frames. I think something like the 4-hour chart. Exactly. Very good. So when we scroll back a little bit, and let me zoom out. Now take a close look at what we have here, okay? So you can see, remember what I told you about this trend lines, right? You see, this is a touch point. This is a touch point. Now, after you've drawn your trend line with like 2 touch points like this, you can see that when price came back to test this area of the trend line, it just immediately touched this area and it bounced above it. If you were trading based on this trend line trading strategy, then this would have been a bullish engulfing candlestick. This would have been a trade setup for you. You would have taken a trade here, place your stop loss below this area. And if you're going for a 1:3, easily price would have hit your profit target here. Again, I'm showing you examples of trades that worked. Does this mean that all of the trades that you're going to take are going to work? Absolutely not. You're going to have trade. In fact, I want you to have that mindset that the trades that you're going to take, you are even going to lose more than you win. Because if you have that mindset, when you encounter a couple of losses, it's not going to faze you, okay? Now, this is one example, okay? And this wasn't the example I wanted to show you, okay? Because this is the trend line bounce strategy. So you draw the trend line using 2 or 3 touch points and then wait for when price is going to come back to the trend line and see how it reacts to it before you take a trade. If it looks like it's respecting the trend line, then you can take the trade with proper risk management, of course. But then there's the trend line break strategy. Okay, how does that work? Here's a classic example of that. Okay, you see, this is 1 touch point, this is 2 touch points, and then this would have been 3 touch points, for example. And then you can see that price eventually broke below this trend line. So when price broke below this trend line, this would have been a trade setup for you. And so you would have taken a trade here based on the trend line break strategy, and then your stop loss would have been here, because if price would have, for whatever reason, gone back after breaking below this trend line, gone back above it, then this would have been a fake out and not a clean break. And so when you take a trade here, risking 1:3, you can see that price would have easily hit your profit target here again. Okay? So the reason why I'm showing you this is because I need you to understand that the 2 ways you can trade with trend lines is, the first method is you can trade the bounce. This is when you identify a touch point, 1, 2 touch points, and then whenever price comes back to the trend line, you wait to see how it reacts to the trend line and then decide whether it's going to respect it and take a trade. But then there's also the break, when price breaks below an established trend line or above it, depending on the type of trend line, and then you take a trade in that direction because you're assuming that price is going to continue in the direction of the break of that particular trend line. And there's one thing I wanted to mention before we wrap up the class, okay? The steeper the angle of a trend line, the stronger the trend is. So what I'm saying is, for example, when you take a close look at this particular example of trend line that I'm using, okay? You can see that it's steep at this angle. This is telling you that for when price was making these higher highs and higher lows here, the uptrend was pretty strong until a point in time came when price could not break above the high which it posted here, and then it started finding it difficult, and then eventually price broke below this trend line. So because the angle here is very steep around this area, price was very bullish, okay? But what if the angle of this particular trend line was something like this? It was almost flat. Then this will tell you that the angle, the trend that we are using the touch points to draw is not that strong. Because if it was very strong, then it would be very steep and not, just kind of almost like flat or 180 degrees, okay? So this pretty much brings us to the end of this week's edition of the ITU Forex class. And if you guys have any questions or anything, please don't hesitate to reach out to us in the comment sections. You just type out your questions and we'll be more than happy to assist you and everything. But before we wrap up, I would also like to use this opportunity as usual to draw your attention to the portion of the company where we use trading bots to trade and get you earning while you're learning, okay? So if you're interested in getting any of our trading bots to help you trade, help you find low risk, high probability trade setup opportunities, and then do the proper risk management and everything for you while you're out there doing what it is you want to do with your time, it's doing it automatically for you on autopilot, then please reach out to us and let us know, and we'll be more than happy to guide you on how to set everything up step by step and get you up and running in no time, get you earning while you're learning, okay, and diversifying a portion of your portfolio. Now, with that said, I look forward to seeing you guys in next week's edition of the ITU Forex class. And once again, thank you for making time out of your busy schedule to come to the class. And I look forward to seeing you guys in next week's edition. God bless you. Have a wonderful rest of your trading week. Cheers.